Welcome to the Deep Dive. Today we're tackling a topic that I think a lot of people put off because it feels so complex and honestly a little intimidating.
Finding a financial advisor.
Exactly. When you first look at the industry, it just feels like this giant maze,
Aha.
all these confusing titles and this alphabet soup of qualifications.
It's absolutely true. And you're looking for a really personal relationship. I mean, this is a partner for huge life decisions.
Monumental ones, like retirement or what happens to your wealth.
Right. Generational wealth transfer, estate protection.
Yeah.
But the industry often makes it incredibly hard to tell the difference between someone who's just selling you a product and someone who's truly acting as your guide.
Yeah, and the sources we analyze today are really designed to give you that shortcut. We want to cut through all that confusion, just focus on what actually matters.
Transparency, trust, and expertise.
Our whole mission for this deep dive is to make sure you walk away knowing exactly how to vet and hire an advisor who genuinely works for you.
So when you're done, you should feel like you're interviewing them, not the other way around.
Okay, let's unpack this. So before we even get into the titles and the fees, the very first step, it's always self-assessment, right? You have to define the specific problem you're trying to solve. If you just ask for a financial advisor, you're going to get overwhelmed.
That's the critical pivot point. One of our sources had a great analogy for this.
Oh, the contractor one.
Yeah. You wouldn't hire a general contractor if all you need is a plumber to fix a leak. Financial advice is just as specialized.
Okay, so let's skip the really basic stuff like budgeting. Our audience knows about that. Let's look at the kind of complexity that really triggers the need for a professional.
Right. Think about situations where the stakes are high and the choices are really nuanced, like complex investment strategies.
You mean beyond just picking a few mutual funds?
Exactly. Maybe you have a lot of restricted stock units from your job or private equity, and you need sophisticated portfolio management.
Or what about specialized estate planning, where it's not just about a simple will?
Yeah. You're talking about setting up intricate trusts or dealing with charitable giving or, planning for a wealth transfer that spans multiple states or generations.
And then there's advanced tax optimization. And we're not just talking about filing your taxes.
Not at all. We're talking about strategically making investment choices, like managing capital gains or using Roth conversions to, legally minimize your tax bill over decades. That's a very specific skill set.
So what are the clear triggers? When should someone listening think, okay, I need help now?
Well, major life events are always the big ones. Marriage, divorce, a big inheritance, selling a business.
Things that add complexity.
Right. These events just introduce a level of complexity that most people aren't equipped to handle on their own. And also just, accumulating a certain amount of assets.
Like a specific number.
It varies, but let's say you have $100,000 or more in funds you can invest. At that point, professional management can really maximize its growth and efficiency.
And this brings up a great point from Kristen McKenna in our source material. We're sort of conditioned to look for someone local.
Yeah, the advisor down the street.
But in finance, that's not always the most important thing anymore, is it?
Not at all. If your situation is nuanced, the priority should be specialized expertise, even if that advisor is entirely online. If you have, say, international assets, a national expert who only deals with that is way more valuable than a generalist who happens to be local.
That sets the stage perfectly, so we know why we need them. Now let's tackle the titles. Section 2, Decoding the Alphabet Soup.
Okay, so the term financial advisor itself is pretty much unregulated. It can be misleading.
Anyone can call themselves one.
Pretty much. But there are two designations that immediately signal a real commitment to planning and to ethical standards.
Okay, first up, what's often called the gold standard for full picture planning, the Certified Financial Planner, the CFP.
Right. When you see that CFP mark, it means that person has cleared 4 big hurdles: education, a major exam, experience, and ethics.
And they're focused on the comprehensive plan, not just one piece of it.
Exactly. Insurance, retirement, debt, taxes, the whole picture. And critically, they are legally held to the fiduciary duty.
Which we will definitely circle back to. What's the other key title?
Registered investment advisors, or RIAs. This can be a firm or an individual, and they're registered with the SEC or state agencies. They typically focus on managing your investment portfolio.
And the most important thing here.
They also have that same mandated fiduciary standard.
Okay, so beyond those two, you might see other letters after someone's name.
Yeah, supporting professionals. You might see a CFA, a chartered financial analyst. They have deep expertise in investment analysis, which is great for really complex portfolios.
CPA?
A certified public accountant. They bring specialized tax insights. These folks are usually part of an advisory team, not necessarily the person running your whole plan.
They're specialists. And what about for people just starting out who maybe don't have complex needs yet,
The online options are fantastic now.
like robo-advisors?
For sure, they're a great low-cost starting point for accounts under, say, $25,000. They use algorithms, manage passive portfolios. They lack the human touch, but the accessibility is huge.
And then there's the middle ground.
The hybrid models, yeah. They bridge that gap. You get the low fees and automated management of a robo, but you also get access to a human advisor for check-ins or for more complex questions. It's a great option.
Okay, that's a great map of who they are.
Yeah.
But the real foundation of trust here, and the most crucial thing to understand, is the legal standard they operate under.
Right.
So let's do a real deep dive on this idea of fiduciary duty.
This is absolutely non-negotiable. When we talk about fiduciary duty, the SEC itself calls this the highest standard of conduct.
Which means?
It means an advisor is legally obligated to put your financial interests above their own, always, without exception.
And it's the continuous nature of that duty that's key, isn't it? They're your ongoing agent.
Yes, they're bound by law to act with the utmost good faith. It sounds simple, but the lack of this duty in, well, large parts of the industry creates a massive conflict of interest.
And that conflict is the difference between a true fiduciary and a broker who only operates under something called regulation best interest.
Or Reg BI. This is where you have to be so careful.
Because the names sound similar. Fiduciary, best interest. They both sound like they're on your side.
They're designed to, but the legal reality is completely different. A broker under Reg BI only has to make recommendations that are in your best interest for a specific transaction.
Just for that one sale.
Right. They have to make sure the product is suitable. But here's the loophole. If a broker gets a higher commission for selling product A and product B is actually better for you but pays them nothing,
They can still sell you product A.
they can legally recommend product A as long as it's considered suitable. They don't have that continuous obligation to find the absolute best, lowest cost option for you if it hurts their own bottom line.
That is a staggering difference. Whereas the fiduciary has to recommend product B, the better, cheaper one, even if they make $0 on it.
Exactly. Their duty is ongoing. They have to constantly monitor your portfolio to make sure it stays optimized for you.
So the single most important action point for anyone listening is what?
You have to ask them directly. Are you a fiduciary, and will you put that in writing? Don't assume anything.
That kind of transparency leads us straight into our next section, following the money. Because these conflicts of interest, they almost always come down to how the advisor is getting paid.
Let's break down the 4 common models. The first, and maybe the most traditional, is assets under management, AUM.
This is a percentage fee charged on the money they manage for you. For portfolios up to $1 million, the median rate is usually around 1%, right?
Yeah, that's about right. So on $1 million, you're paying $10,000 a year. And that percentage usually goes down as your assets go up.
Okay, then you've got project-based fees.
Right, like hourly fees. This is for, quick consulting on one specific issue. Often runs about $250 to $350 an hour.
And what about a flat fee?
That's a set price for a specific service.
Yeah.
Like creating a comprehensive financial plan from scratch. A median fee for that might be around $3,000.
And finally, there's a newer model that's gaining traction, the subscription or retainer model.
This is really popular with advisors who work with younger clients who maybe have high incomes but haven't built up a huge portfolio yet. You pay a monthly, quarterly, or annual fee for ongoing access.
Okay, now here's the real aha moment, I think. This is where you separate the good from the conflicted. The difference between fee-only and fee-based.
This is the game changer for minimizing conflict. A fee-only advisor is compensated only by the client fees we just listed. AUM, hourly, flat fees. That's it.
Their income isn't tied to selling any product.
Exactly. But a fee-based advisor, and that little extra word makes all the difference, they earn those client fees plus commissions from selling products. Could be annuities, certain insurance policies, or mutual funds that give the advisor a kickback.
So even if they're following that best interest rule, the conflict is still built right into their business model.
The incentive is still there. As Aaliyah Padamsey said in our sources, do the math so you know how much you're really paying. If an advisor's fee looks really low, you have to ask where the rest of their money is coming from.
That is such a vital warning.
Yeah.
What else should people look out for on the cost side?
Be aware of high minimum investment requirements. A lot of traditional wealth managers won't even talk to you unless you have, say, 250,000 or even 750,000 to invest.
So if you're below that, you need to look at flat fee advisors or the robo platforms.
Right. And always, always check for hidden costs. Third-party fund expenses, trading fees, and especially performance-based fees.
Rewarding them for good performance sounds good on the surface, doesn't it?
It sounds great, but it incentivizes the advisor to take on more risk with your money just so they can hit a benchmark and get a bonus. That risk is all on you.
Okay, so if their pay is tied to transactions or products, proceed with caution.
With heightened scrutiny, for sure.
All right, so we've defined our needs. We understand the titles, the fees, the fiduciary standard. Let's move to Section 5. Vetting your partner. How do we actually do the search?
First, finding them. You can start with your trusted network, friends, family, maybe your employer has a program. But the best filters are the online directories that require high ethical standards.
We'd suggest starting with the CFP board's letsmakeaplan.org. Or you can search directories from groups like NAPIKIFE or the Financial Planning Association.
Those are great because you can filter specifically for fiduciary status and for their specialization.
And once you have a short list,
The interview process begins. James Lee, in our sources, says you have to interview at least 3 advisors. Take advantage of those free initial consultations. It's your chance to assess them.
let's run through the key questions. Beyond, are you a fiduciary? And how do you get paid? What else do you need to ask?
Get specific. Ask, what is your experience with situations exactly like mine? Have you managed concentrated stock options before or planned for a family with a special needs child? Don't accept a generic answer.
And you need to ask about their investment philosophy, right?
Absolutely. How do you approach risk? What's your core strategy? You need to make sure their philosophy aligns with your own comfort level, and also, how many clients do you have?
Oh, to see if they're spread too thin.
Exactly. If they have a massive client load, you might not get the attention you need.
And before you sign anything, mandatory homework.
Due diligence is non-negotiable. You have to check their background. Use the SEC's IAPD database and FINRA's broker check. Look for any complaints, disciplinary actions, anything.
What are the immediate red flags that tell you to just walk away?
Any attempt to hide or downplay their conflicts of interest. High-pressure sales tactics are another huge one. Tezzigo calls them old-school sales techniques. If they pressure you to buy something on the spot, they are not a partner.
And of course, fees that seem way out of line with the industry standard.
Right. And the final check from Niv Prasad is just personality fit. This is a partnership that could last for decades. You need an advisor who listens, who explains things clearly, and who gets your values. If the communication feels off, it's not going to work.
Trust is built on communication.
Just as much as it's built on a legal duty.
Okay, let's wrap this up in Section 6, the logistics, once you've actually picked your partner.
Once you've made your choice, make sure that final agreement spells out everything. All the fees, all the services, the whole scope of work needs to be on paper.
And it's important to remember, your actual money isn't held by the advisor, is it?
No. Per SEC rules, your assets will be held by a qualified third-party custodian, like a major bank or a broker-dealer. This protects your money.
And you'll also decide on the management type.
Right. Do you want discretionary management, where the advisor can make trades for you? It's convenient. Or non-discretionary, where you have to approve every single transaction.
You choose the level of control that lets you sleep at night.
Exactly. And from there, the advisor delivers your financial roadmap. This is usually captured in an investment policy statement, or IPS. It's the foundational document that outlines your goals, your risk tolerance, and the strategy they'll use.
And this is a living document, right? It's not set in stone.
It's ongoing. You have to establish regular meetings, quarterly, semi-annually, and promise to update your advisor whenever your life changes.
This has been so clarifying. I think for you, the listener, the central lesson here is empowerment. Finding a financial partner doesn't have to be this high-stakes guessing game once you understand the core issues.
Define your needs, demand that fiduciary duty, and dig into the fee structure.
By asking those targeted questions, you really transform yourself from a potential target into an informed client.
We talked about that investment policy statement, the IPS, which is your financial roadmap. But life rarely travels in a straight line. You're going to hit unforeseen changes, a market crash, a career shift, whatever it is. So the most important question isn't just what are my goals today? It's how will my partner and my plan evolve when things get messy? The ability to adapt under pressure, that's the true measure of a solid financial plan.